So you think Ethereum validators control the blockchain, right? Well, before a block is ever finalized, there is a completely invisible power structure that activates right behind the network. We're talking searchers gaining transactions, builders constructing profit-maximized blocks, and relays seamlessly coordinating the transaction flow between them. The blockchain that everyday users see, that's really just the final output of a massive hidden infrastructure market competing right beneath the surface. Transactions are no longer simply processed anymore. Today, they are simulated, reordered, bundled, auctioned, and strategically routed through systems most users never even realize exist. And as Ethereum evolves, it increasingly resembles a high-frequency financial machine, where visibility, speed, and infrastructure access totally determine who holds the power. So the real question we need to answer in this explainer is no longer just how Ethereum works, but who actually controls the transaction flow before the blockchain confirms anything at all. But real quick, before we jump into the mechanics, a standard disclosure. This video on the channel, Blockspace Funds, is created for educational and informational purposes only and does not constitute financial or investment advice. Okay, let's get into it. All right, let's step into this cybernetic deep dive of the network's true architecture. For most people interacting with a network, the life of a transaction looks incredibly straightforward, right? Almost linear. You sign a transaction in your user wallet, it gets broadcasted into a public waiting area known as the mempool, and finally a validator node, randomly selected by the protocol, scoops it up, processes it, and confirms it on the blockchain. This is the visible, standard narrative that most of us believe is the full picture of decentralized consensus. But here is the million-dollar question. Who actually controls that transaction flow before the blockchain confirms anything at all? Because the reality is that public mempool is literally just the surface layer. Beneath it, validators have almost entirely outsourced the actual job of constructing blocks. What exists now is a highly specialized, insanely competitive cybernetic city operating in the shadows, populated by searchers, builders, and relays. So let's completely shatter this illusion of the simple ledger.
Down the rabbit hole we go, searchers and MEV. We're transitioning out of the public view now and stepping straight into the hidden surveillance chamber of pending trades, the true battlefield of Ethereum. To actually understand this hidden city, you have to understand its currency, MEV, or maximal extractable value. Now, this is the profit generated by strategically reordering, inserting, or even censoring transactions within a block right before it gets finalized. We're talking about incredibly lucrative activities here: decentralized exchange arbitrage, automated liquidations, and sandwich attacks, which is basically where a bot places trades right before and after yours to siphon off your value. Transactions are no longer just simple data transfers being processed. They are highly valuable assets in a digital war room. Out here, advanced AI systems and algorithms are simulating massive bundles of trades in mere milliseconds, looking for the absolute optimal mathematical order to extract maximum value. And if you take a look at the data, you'll see these towering vertical spikes in daily MEV and gas revenue. Those aren't just random days of high network traffic. Those are actual flashpoints of extreme value extraction, specifically during major market events like the FTX or SVB collapses. When you see data spikes like this, it becomes very clear that Ethereum behaves a lot less like a simple bookkeeping ledger and much more like a high-frequency financial battlefield, where millions of dollars in arbitrage profits just flash across the network in the blink of an eye. Now, what's really fascinating here is how the labor is actually divided into three highly specialized camps. Remember, validators don't really do this heavy lifting anymore. They outsource it to industrial block factories. First, you've got the searchers. These are the sophisticated actors constantly scanning the mempool for arbitrage opportunities and bundling transactions together. They then send these bundles over to the builders. Builders take all these different bundles, mix them with public transactions, and basically act as architects, optimizing and constructing the single most profitable block mathematically possible. And finally, you have the relays. Relays act as doubly trusted intermediaries. They escrow the blocks and coordinate the safe delivery between those builders and the ultimate validators.
Moving on to the MEV Boost Global Auction. This entire ecosystem is held together by a quiet, globally distributed auction infrastructure that routes Ethereum's information flow perfectly, without the validators ever actually seeing the underlying strategies being used.
Tracing the architectural blueprint of MEV Boost, you can really see the flow of data starting from the searchers and private order flows, feeding straight into the builders on the assembly line. The builders assemble the full block and send it to the relay. Now, the relay is the absolutely crucial piece here. It keeps the actual contents of the block completely private. It only sends a blinded block header to the consensus client, the validator. Only after the validator commits to proposing the block by cryptographically signing that header does the relay release the full block body. It is just a perfectly orchestrated trustless handoff that completely prevents the validator from stealing the builder's MEV strategy.
12 seconds. That is exactly how long this entire holographic marketplace has to operate. Every single Ethereum slot is just a 12-second window. And in this incredibly tight time frame, an intense ascending bid auction takes place. Builders are out there competing in real time, submitting higher and higher bids to the relays to win the block, constantly updating their mathematical models right up to the absolute final milliseconds before the slot deadline. It's wild. Next up, the economics of centralization, because this is where we hit a paradigm-shifting break in the standard narrative. The romantic illusion of total, flat decentralization is severely challenged by the very real choke points rising up in this hidden market. So the absolutely crucial point here is the underlying game theory driving this centralization. Recent game theoretic analysis of these block building auctions reveals a pretty fascinating dynamic. You might naturally think that a builder making more money pays more to win, right? And they do. Mathematically, the builder with a competitive advantage, say they have better algorithms or exclusive access to private order flow, they can totally afford to bid more in absolute terms to guarantee they win the block. But because their total extracted MEV is just so massive, that higher bid actually represents a proportionately lower percentage of their overall profits. This game theory allows them to pay more to win, while continually compounding their wealth and their margins. This mathematical reality inevitably drives heavy centralization in the builder space, effectively turning a few dominant builders into massive network choke points. And this is where things get really delicate. Notice the mathematical tension mapped out in order flow auctions, or OFAs. An OFA basically has to balance two competing forces, attempting to redistribute some of that MEV back to the regular users who originated the transactions in the first place. If the auction offers a high rebate to the user, returning value back to them, it inherently leaves a lower inclusion fee for the validator, and that can result in slower on-chain execution. Conversely, if the user rebate is low, the validator gets a super high fee, which practically guarantees lightning-fast block inclusion. But the user loses out on their extracted value. So it's this constant, delicate balancing act to optimize this double auction problem and protect the everyday transactor from hidden taxes on their trades. 90%. Today, over 90% of all Ethereum blocks are constructed through this outsourced MEV Boost market. Let that sink in. This isn't just some fringe subculture of developers. This is literally the deeply embedded fundamental infrastructure of the entire network. If you transact on Ethereum today, your data is flowing through this invisible assembly line. Encrypted tunnels, Ethereum versus Wall Street. We are now venturing into the darkest parts of the forest here, observing how the rise of private order flow is causing Ethereum's architecture to heavily mirror traditional finance. Let's contrast these two environments for a second. On one side, you have the public mempool. It's a chaotic, fully transparent waiting room, making it highly vulnerable to predatory front-running and sandwich attacks. Because of this, users and searchers are increasingly routing their transactions through encrypted tunnels to protect themselves, causing a massive migration to the other side, private order flow. Services like Flashbots Protect guarantee pre-trade privacy and prevent public front-running, but they also create a system of privileged exclusive access, essentially hiding the order flow from the rest of the network entirely. What we're witnessing is essentially the Wall Street evolution of the network. We're seeing high-frequency trading bots, dark pools relying heavily on private routing, exclusive order flow agreements between searchers and dominant builders, and highly specialized algorithmic execution. If you look closely, Ethereum's current builder market has morphed into this cinematic, cybernetic version of Wall Street's hidden dark pools and HFT server farms. So, the future structure of Ethereum. Looking forward, how is the protocol actually attempting to balance decentralization, privacy, and efficiency against these massive centralizing forces? Well, the network is actively upgrading the machine to mitigate these risks. On the horizon, we have enshrined proposer-builder separation, or EPBS, baking this separation of powers directly into the protocol itself to completely remove the need for trusted third-party relays. We have Suave, a single unifying auction for value expression, aiming to decentralize the builder role, alongside encrypted mempools and decentralized sequencers to hide transaction data until it's actually safe. What you see is an ecosystem fighting really hard to redesign its architecture to preserve fairness without sacrificing the immense efficiency of these specialized builders. So let's zoom back out to that standard validator node we started with. The reality is now laid completely bare. Blocks are simulated, optimized, auctioned, and coordinated before consensus. The blockchain was only the visible layer. The invisible machinery of searchers, builders, and relays is what truly brings the network to life every 12 seconds. So the next time you submit a transaction, I leave you to ponder this. In a landscape heavily defined by private routing, algorithmic warfare, and dominant builders, who truly controls the invisible machinery of the network?